And we're live. G'day, this is Zenium Live, and I'm your host, Scotty North, and we're here to talk all things money, finance, and property. And it's Thursday afternoon, so as I always say, it's the end of the work week. And not only that, it's potentially the end of the work year as we come up to Christmas, because PJ Patterson, you're here for the end of year financial markets wrap. Is that right?
Yeah, we're wrapping early this year. The financial markets can now just close, and we can go on holiday for 2 months and come back and see how the world is traveling. No, it's
Because
not
they
quite that
stop
simple.
when you go away, right? They just stop because they don't trade while you're not there watching them. Is that right?
No, they don't. I wish that were the case. That would be very useful if that were to occur. But of course, given the planet does not revolve around me or you, that's wishful thinking. Wishful thinking.
Okay.
Anyway.
Well, all right. What have you got for us for coming into Christmas and as a wrap for the year, mate? Take us through. We don't probably need too many reminders of the bad things, but let's just get a recap of where it stands now and then where we're looking forward over the Christmas break and into next year.
Not a problem at all. Well, we certainly are. We've had a very challenging year this past year, but the economies of the world, ex-Australia at the moment, seem to be powering ahead. There's a little bit of turbulence in Asia, which is infecting Australia as well. But of course, we've had a series of lockdowns and extended lockdowns, so our economy is still well and truly in recovery phase. But the U.S., Europe, powering ahead, will likely continue to do so into next year. I think we're going to have a fantastic Christmas period. I think that's going to help to drive recovery, continue to drive recovery in the U.S. And Europe, and we'll hopefully see lockdowns and things lifted here in Australia so that people can get out and spend and really drive the consumer spending side of things, which is a big portion of our GDP. But what I might do is just take it back to the very high level and the things that I look at in my quadrant model. Actually, it isn't my quadrant model, it's Hedgeye's quadrant model, but it's a fantastic model to use for the full cycle investing process. And those three big macro input factors are growth, inflation, and interest rates. So growth is GDP, interest rates, and inflation is inflation. And the direction of those things, if you get those right, you're going to get a lot of things right in the global macro story. And so as we speak, and I'm sure Australians have noticed in the last couple of weeks, here in Australia, we've seen interest rates beginning to rise. Now, the RBA hasn't officially increased interest rates, but the bond market in Australia, sensing the fact that we've got a bit of inflationary pressures that have built up in our economy here in Australia, is pricing in some rate rises next year. So the RBA is very likely going to have to increase interest rates to put a dampener on inflation, which is running reasonably hot. But also they'll probably be trying to cool down this red hot property market as well. So we can certainly be anticipating that interest rates are going to rise in Australia. The good news about our growth story here in Australia is that it also should be increasing, but we're not going to see a substantial increase in GDP really until the third quarter of next year. The first quarter and the second quarter, so I'm looking at fiscal year quarters. So the January, or the March and the June quarters, so those are quarters 1 and 2, are going to see mild increases in Australian GDP, not anything to set the house on fire, which means we're still going to be struggling a little bit to get off the mat, as it were, the economic mat. But by the time we get to the back half of next year, Australia ought to be looking quite good and powering ahead. Juxtapose this with the U.S., and we're seeing that, again, growth is continuing to power ahead as they recover. Inflation in the U.S. is running red hot, and interest rates are also tipped to be rising next year, with the Federal Reserve there looking to hit the brakes or tap them higher. What'll be interesting in the U.S. in terms of all of this is that as we enter the mid to back half of next year, the U.S. will probably start to slow. So we'll have Australia picking up steam, the U.S. slowing down. Obviously, as we get into next year and we get into that part of the year, we'll see what the data is showing and what's happening at the time. But that's sort of the broader macroeconomic things that are going on that are likely to affect and move markets.
So we always come back to inflation. I mean, it doesn't seem to matter what topic we wind up wanting to talk to, we end up bringing up this topic. So the question is, there's a lot of talk, especially in the US, about that at the moment. Mm-hmm. On even anything. Doesn't matter what it's, if it's related to money or it's related to some sort of stimulus or it's related to jobs. this inflation is a word in that article. Um, do you want to give everyone a bit of a brief overview of why that's such topical at the moment? Is it simple? Is it just as simple as because they're printing too much money, or is there more to it? And what is the way around it apart from raising interest rates? I mean, does it become its own self-fulfilling prophecy as the more they go down, the more it inflates, and so on and so on? How does that
Yeah.
work?
Well, the inflation story is several-fold at the moment. So we've got a lot of pressures that have built up in the economy. So first of all, you've got things like labor pressures. So people have not returned to work maybe as quickly as they could have due to the reopening in the U.S. But certainly wage growth has lagged over the course of the last few years. But now we're seeing shortages of labor. So even basic jobs like just getting people to go back and work in hospitality is something that many businesses are struggling with. So we have wage price inflation, which means that wages are going up. So margins are getting squeezed. And what suppliers or service providers can do, of course, is they can absorb that, or what they can do is raise prices. And so many of them are raising prices. So that's one of the first big issues that is having to be dealt with. I think this is happening in Australia as well. The second big issue is there are supply constraints. So the global economy just got completely stuffed during the COVID period, and we have not seen a return to the normal level of global trade. So all the ships and things that are moving stuff around the planet, I have, and it's not anecdotal, it's actually real. There are literally hundreds of freighters and shipping container vessels that are sitting off the coasts of major seaports. So the U.S., in California, on the Atlantic side as well, because the port capacity is constricted. So they don't have enough, for example, truckers to move this stuff around. So there's a number of things, you could call them supply chain bottlenecks that have occurred. And this too is driving up the cost of goods, because if you have a supply issue or a scarcity issue, then of course the prices are going to rise. That will also resolve itself over time. And then finally, probably the biggie, the 800-pound gorilla in the room is, of course, they have printed, this is a technical term, a shit ton of money. And it's found its way into, which it always does, into things like housing and the stock market in the first instance. And so what we've seen is a lot of asset price inflation. And that's what happens during Quad 2, is you see a lot of inflation coming into the market. And so inflation is the result of money printing. It isn't money printing necessarily. So the money printing is growing the money supply, or the base of money out there, but you still have to have velocity of money. So the turnover of the currency and the fear that the dollar you receive today isn't going to buy the same amount of goods and services tomorrow. And so people get out there and they spend it and they increase the velocity of money. Anyway, all that is to say that inflation has really begun to tick upwards. It's also a function in many cases of the US dollar and its strength or weakness. Now, surprisingly, the U.S. dollar has started to it's entered into a bit of a bullish trend at the moment. So what that means is that it will appreciate against most other major currencies: the yen, the euro, the Aussie, the pound, the Swiss franc, etc. And so, which is unusual, because typically the U.S. dollar only does really well in Quad 4. So this could be a very short-term thing. We'll have to see. But things like oil and all the commodity complex also have, we've seen price increases across the board because of supply constraints, et cetera, as I've already mentioned. So for the time being, the inflation story is going to stick around. The Fed, you may recall, I think we probably did this on a show a couple months ago, where I used the word transitory. They were trying to paint this inflation thing as a transitory thing, like it was only temporary, like it was going to be around for a month or something like that. Like, are you serious? These guys are always behind the curve. But anyway, now they've acknowledged that it's actually a thing, and the consumer's feeling it big time. You know, the prices of rents in the U.S. have gone just through the absolute roof. So if you're a commercial property owner in the U.S. right now, you're laughing because rents are up in some major cities by 70 or 80%. It's just phenomenal. So that's inflation, and it has a wide-ranging impact. And as we've also discussed, it's the silent tax. It's the tax that you don't pay explicitly, but when you go to do your shopping, inflation means that you're basket of goods is a little bit smaller.
So is this year is let's say that this year is the year that perhaps caused inflation, if we just want to term it in casual terms. Is next year going to be the year that we really feel it, or it's going to be the only topic on everyone's tongue? Is coronavirus going to be replaced with the word inflation in 2022?
Yeah, somehow I doubt that. I think that coronavirus will stick around, although all the climate changer folks have, greenhouse folks have gotten a little bit feeling unloved, I think. So we're starting to see all that wedge its way back into the headlines. So we'll probably get back to the usual suspects that dominate the fear headlines in the mainstream media, being coronavirus, climate change, and probably now the specter of inflation. Yeah, we'll probably see that hanging around for a little bit, but the reality is that it'll be too little too late. By the time they acknowledge it, it's already too late. I mean, inflation has been building, has been ramping up for the last, sort of 12 to 18 months. So it's not like this is a thing that's all of a sudden just happened. It's been building and has been moving through the economy at speed for a number of months. It's just that the mainstream media and the Fed, who are, let's call them inflation deniers, don't want to acknowledge it, because that makes the public get angry, because they don't like inflation, because it means, again, the costs of the stuff they buy every day that they need, like food and fuel, keep going up. And if you're not seeing wage price increases, or not wage price, but if you're not seeing a wage increase commensurate with the inflationary increase, well, you've just gotten poorer. So, a lot of folks are feeling that.
Yeah, that's a good point. All right. So moving on, you've done the wrap for the year so far. What we've seen, we've talked a lot about inflation and where we probably see that's going and what it's going to do. What sort of not exact stocks, but subset of stocks and trends should clients be looking out for? Maybe not over Christmas because people sort of log off, but for next year, is there an industry or industries that are going to be hot target for investing in?
Most definitely. So for the next year, and I think even the remainder of this quarter here not but in Australia and in the U.S., we need to continue to be invested in things like energy, technology, high beta stocks, pardon me, small caps will also continue to perform well. So there's a number of sectors that you certainly want to maintain exposure in. And there's a few sectors you want to continue to avoid, like treasuries, anything that's really interest rate sensitive, utilities, treasuries. REITs are a bit of a funny one. There are some good REITs out there that don't seem to have those same issues that other REITs have when interest rates start to rise. But nevertheless, it's still a quad 2 scenario in the U.S. and global equities really at large for the end of this year. Asian equities, China is a little bit of a basket case at the moment, and it's infected some other economies in the area. So we have this ongoing thing with China and their massive property sector, being virtually on the brink of collapse, with Evergrande and there's some other company whose name I can't remember, going to the wall because, surprise, surprise, they've levered themselves up to the hilt. And
who would have thought?
Who would have thought, right? And the Chinese economy is in a stagflationary environment right now, which is just horrendous if you own debt. So anyway, it's the Asian economy is probably staying away from at the moment, but certainly the U.S., Europe, continuing to power ahead. Australia, caution, probably pretty light on the Australian equities. But moving into next year, we are going to see, and I will be putting on some sort of quad pivot or a shift in the asset mixture, probably moving a little bit from the aggressive stance that I have right now in terms of being sort of all in with equities, moving back to maybe a slightly more conservative, and even by the middle of next year, potentially a defensive stance, anticipating a possible quad 4 in the U.S., which is going to be maybe a mild quad 4, but it's still going to be a slowdown in GDP and a slowdown in growth, because we will have had all the big recovery stuff happening, and it'll just be a kind of a case of the comps, the GDP comparisons will just show a slowing based on the base effects that happen over a period of time. So that's
Is any in the market, is any slowdown bad? Like, I mean, let's say that I'm going to use figures here because it's not my area, right? So let's say they're growing at a 5% growth rate per year as growth, just in terms of enlarging, and then that drops to a 3%, so it's gone down to 2%, whatever, but it's still growing at 3%. Is that always deemed as a bad thing because it was at 5, now it's 3, or is it still okay because it's still growing anyway at 3?
No, it's a bad thing
Yeah,
because a slowdown is a slowdown. I mean, 5 to 3 is still a 2%, loss in say GDP growth, and that's massive if you
yeah.
think about it, I suppose. So yeah, it is a bad thing. And again, this is where the full cycle process and the looking at those global macro factors really help you determine how to position your portfolio, because a slowdown means, if you think of it this way, a slowdown in GDP growth means that company earnings and by default company profits, and I'm speaking generally here, but company profits and company earnings are going to be slowing. Now, if you're a stock market investor, and right now, I don't know what I don't really pay attention to this, but I don't know what the stock market PE ratio is, but it's probably in the US upwards of 24, 25, 26, something like that. That's a pretty high premium to be paying just on a PE basis. So if GDP starts to slow, the assumption can easily be made that we're going to see company profits begin to also slow, and this is exactly what was happening just before COVID put the dagger into us back in 2019. We were
Yeah.
already seeing that GDP was slowing, and by default, earnings growth was slowing. And we had made, in my firm anyway, we had made the pivot to more defensive assets, and of course that was just timely. We just kind of we were in the right place at the wrong time, I suppose. But it ended up being the absolute best move to have made at that stage. So again, we'll probably be seeing something similar by the middle of next year in the U.S. With a slowing of the economy.
Okay, so you said earlier that the end of next year is looking good for Australia, but the end of next year is not looking so good for the US. What does that mean for Australia? Like, what happens when we're good and the US is not so good?
Yeah, that's a good question. So, what that likely means for Australia is that we will enter a reflationary environment. So, we'll start to see, I suspect, our currency will strengthen. We will see our economy broadly improving. So, our GDP growth will begin to reaccelerate off of these very low base effects. I suspect, too, that the RBA here will raise interest rates, but then might have to cut them. Now, we'll see what happens with that. They might raise them a little bit to deal with the inflation issue. They may be able to get inflation under control. And there's a number of other sort of they call them macro prudential things that are being done. For example, tightening up credit standards and stuff like that are going to hopefully constrain some of the cash that's been flowing into the real estate market. So for all you property investors out there, I think the growth that we've seen in the last year or two, probably we're not going to see that over the next year or two because of what I've just explained. But I would also think that as China gets out of the shit that they're in, they will begin to restock things like copper and iron ore and coal and all of this stuff. Apparently, there's a massive coal shortage in China right now, so I guess there's going to be some people over there freezing to death over the Chinese winter. And I'm not making a joke about that. Like, I truly think that could be a problem over there. And so as they deal with those things, I would have to think that's going to be a beneficial outcome, or the benefits to Australia will be good and will drive our GDP.
Okay, all right. No, that's good. Now, look, once you touched earlier on just then on the coal issue and also on the environmental climate, people feeling unloved and they're back on the cards again.
Yeah.
Now, those two things are fairly well connected, right? I mean, Australia went to that COP26 or
Glasgow.
whatever,
Mm-hmm.
yeah, the conference thing. And so now we're like, oh, we don't want to do coal, we're trying to move out of that. And yet there's coal shortages in places and people are in trouble.
Yeah.
So let's shift. I don't know how much you're into this, and I'm putting you on the spot, but ESG, right? So all the stuff moving forward with ESG, and if you want to explain a little bit of what that means to the people watching, and also after that climate summit thing, I read an article that said that funds management companies, to the amount of that had under their belt $130 trillion in funds under management, have made a commitment to be focused on ESG. Now, that is a lot of money moving forward, and that's obviously going to sway where a lot of this investment dollars go in the years ahead, years and decades, perhaps. So, what is your take on that?
Well, ESG investing. So ESG is, I believe, environment, sustainability, and governance. I think that's what that acronym stands for. And it's sort of been a thing that's been created now as a way to measure, and that there are measures out there of how companies rate in terms of ESG investing. And it's really, I mean, it's kind of self-explanatory, but the companies get a rating on are they good for the environment? Are they sustainable companies where they're trying to be sustainable, I suppose, and not be net users of resources, and then have good governance around things like, just good corporate governance, but also not taking advantage, I guess, of cheap labor across the globe and things of this nature. And I think ESG investing, my personal take on it is I pay no attention to it. I really don't. I want to make money in the markets, and that's what I'm most concerned about. And this is what I say to my clients. You know what? I want to make you as much money as I possibly can. And then you can choose how you spend your wealth. If that means you want to go and support programs or charities or whatever it is around the world to help with a variety of needs that we have on this planet that are not being met by governments, certainly please feel free to do that. And the enabler, I'm an enabler of that. I want to, again, make as much money as I possibly can for you. So I'm pretty agnostic around all those sorts of things. Having said that, I probably do stay away from one or two industries that I think are kind of bad for the globe in general. I do not invest really in any coal-related stuff. But the fact of the matter is, we rely heavily on fossil fuels, and I think a lot of people, get very emotional about this particular topic, and yet they attend rallies and they drive their car there. So I just think that's a bit hypocritical of many of the folks in this movement who have been unable to get off the grid and go totally solar in their homes, still rely on public transport or their vehicles to get themselves around, et cetera. So there's a little bit of hypocrisy in all of this, but I still think, and I suppose the way I view ESG and this type of argument is, deal with the thing that you can deal with, which is your immediate home and your immediate family and immediate community, and do everything you can do within reason to try to make the world a better place. I'll give you an example of this. At my home, I had solar panels installed. No, it doesn't mean I can be off the grid, but it means that a little bit is going back into the grid from clean energy generation. I have water tanks at my home, so I don't have to tap into the water supply during a drought period, unless, of course, my tanks are empty, but in which case I tend to just let the grass go brown. But in any case, I'm doing a few things in my own that I can control to be environmentally, socially, and, well, not from a governance standpoint, but just be more responsible around it.
And that's right. And I think if we all do that bit, that's all good. And I agree with what you're saying there in terms of the purpose of investing is to make the money. The thing that I see is, if these people, and look, it's all words, right? These conferences and these summits are all just, we come there and we all shake hands and we're all got an accord, we're on one accord, and who knows what actually is going to happen after that, right? But the point is, if there is companies with 130 trillion in assets that start making decisions toward, I don't know what an ESG project is, right, or an ESG investment, but if they do, that's a lot of money going towards that. Would does that come on your radar from investment perspective, irrespective if it is ESG, if it's not ESG, if they're just talking ESG, if there's a whole bunch of money running towards somewhere, do you want a piece of that action? Is that how it works?
Yes, sorry, I understand exactly what you're saying now. And no, I don't pay any attention to it at all. I think a lot of these things are fad-based, and I am process-driven and quad-driven. So ESG and some of these companies like, not ESG, but the environmentally, what's the word I'm looking for? The sectors of the market like solar and wind and hydro and all of that, they will typically do well in certain quads. In other quads, they won't. So a lot of those investments
Right.
are, like
Okay.
utility companies and things like that are
Yeah.
providing this stuff. And most of those business models actually lose a lot of money. So, again, they're not really something that I pay any attention to at all as an investment asset class. So,
Yeah.
yeah.
Yeah, no, that's okay. No, that's why I wanted to ask you that because,
Mm,
um, because you've got your quads based thing, and like I use the property cycle for our property stuff, and it's the same sort of
mm.
answer, right? I mean, depending on the stage of the market, depending on what's going on where, is depending if that's a good investment or not, irrespective if it's ESG, if it's, the world's most polluted thing or whatever. I mean, I'm not saying I'd invest in that, but I'm saying
Mm.
that some of those things are well outside of the control of that if it's more of a market-based thing. So that's very interesting. So once again, we're just being paid lip service to and all these events that
Well,
come on, mate.
I think that look, our world leaders certainly have to meet and have these conversations. There's no doubt about it. But I watch a lot of documentaries on many different topics, and a lot of them have to do with the use of the natural resources that we have on this planet. And Kiss the Ground was something that I watched on Netflix recently, a fantastic documentary about kind of sustainable farming. And it really opened my eyes to how simple it would be for us to actually reverse and deal with the effects of global warming. And I think we are seeing temperature fluctuations, whether or not it's natural, whatever, the science on it for me is not 100% settled. Don't obviously want to get into a political argument about that, but the fix is right before us. But it takes government will, and it takes education of the farmers, as an example, to be shown a better way to do things. And I think if there was a will to do that globally, to really attack and address the issues that are the problem, then we could solve this problem easily. But sadly, I just think things like carbon trading schemes and taxing carbon, all this, absolute waste of time. Absolute
Yeah,
waste of time. People just find a way around it. Let's
it's just
address the
shifting
root
money
cause of the
around.
problem.
Yeah,
It
it
is,
does.
and it's a clever idea, but it's the typical government response to something, which is, oh well, if that's a bad thing, let's tax it, and maybe people will stop doing it. Well, actually, that really doesn't work. All you got to do is look at cigarettes and alcohol, and you can see that they've been unable to tax those two things into oblivion.
Yeah,
So I mean, carbon's not going to be any
mate.
different.
It's interesting because we've got a bit of land and we could actually get carbon credits or get paid or whatever it is. I don't know. I just
Mm.
looked into it briefly to plant trees as long as you don't cut them down and do whatever. Or if you do cut them down, they've got to go back into the ground. And I'm going, what? You're going to pay me to plant trees? Now, we haven't done it. We kind of like our bit of open space, but
Mm.
it's bizarre some of the things that are out there that are around here. And this is kind of what I was alluding to with if there is this hype, and as you say, I agree with it, it's like a hype and a fad thing. There's all
Mm.
this money being thrown around in these areas. It's like, some people are going to make money, some people are going to lose money, but there is money gravitating towards these hyped up fad things, I reckon.
There are, and it's a bit sad because definitely people get caught up in the emotion of all of this, and they don't really spend enough time, I think, analyzing the sustainability of something or whether it's even the right thing to do. Like I constantly marvel at people that drive Teslas. It's because of coal and oil, and in steel production in particular, coal, that car was able to be made. And and the lithium that got extracted from the ground and refined was because of fossil fuels. So they've bought this car that was entirely made because of fossil fuels, and it makes them feel better because they don't have to go to the petrol station to fill it up. Like, I just think
Yeah.
it's so ridiculous in my mind, that it just beggars belief. But anyway,
But you're a
it's
dinosaur,
faddish.
PJ. Come on,
I
dude, you're a
am.
dinosaur now. It's like what
Yeah, I
we're a
know.
dinosaur. I'm a dinosaur. It's mate. If you're over 40, you're out of date supposedly. So there we go. We're in trouble.
Yeah, we are in trouble.
Um, all right. Well, look. We almost out of time. So any famous last words for the year before we log off?
Well, no, I think that we're all going to be very pleased to see the back of 2021. And I really do want to thank all of the Xenium Live viewers and extended family of Xenium Live who watch these shows. And I know it's a little bit early, but a happy New Year to everyone, and a very Merry Christmas and happy holidays to everyone as well. I hope you're able to spend time with your families and celebrate with loved ones despite all of these ongoing restrictions. So all the best from me to you.
Look at that, mate. Where's my tissues? I'm gonna
got a tear.
Got a tear in the eye. It was very heartfelt. All right. Thank you again, PJ. Information has been great. I've taken 3 pages of notes just sitting here, and I'm actually supposed to be listening to what you're saying on the show. I shouldn't be writing, but it's too much good information. If you have any more information that you want to know, hit us up. There's been scrolling at the bottom of the screen at zenium.live for the internet site, and hello@zenium.live for the email address, or 1300 667789. And that's it for PJ for the year, because I think now he just goes away and he's gone for 3 months of the year. He only works part-time, really. I think, don't tell him I said that. I'm sure he can't still hear me now. And look, that's really good information. And thank you to everyone listening on the podcast. That is the Zenium Live podcast, available at all good podcast outlets. All right, we'll be back for a final show next week for the end of the year. And that's it. We'll see PJ next year or next time he's on the show. All right, that's it. I'll speak to you soon. Bye.